Market regulator SEBI is beefing up the surveillance mechanism in light of rising exposure of individual investors in the derivatives segment. Vijay Ganeshan Iyer joins us with exclusive details. Vijay, why this sudden move? What is bothering the market regulator? We are talking about, stress test for, high net worth individuals. Is it too much of interference by SEBI? What exactly you are gathering from your sources? Why this move has come?
So that's a very interesting question. Firstly, the whole objective of SEBI here is to ensure that enough systems are put in place to handle any high volatility in the equity market. So just to give a background, currently SEBI surveillance systems has a capacity to manage any volatility in the range of 5 to 10%. So SEBI clearly wants to enhance that further, and that is where the target is any volatility in a single day in the range of 15 to 20% also. They want the systems to be in place, particularly the surveillance mechanism. That is where they now are doing stress tests at individual level. These individuals are players who have large exposures in the equity markets. Also, they have high open-ended positions in derivatives. That is where this stress test is being done at individual level to ensure that in times of volatility there is no issues when it comes to settlement. Because just recently SEBI has also completed a stress test at the brokerage levels, and they have put in checks and balances to ensure whenever there's volatility, the margins automatically go up depending on the exposure that brokerages have. So the whole system or the whole objective here is to ensure that enough checks and balances or systems are in place and settlement doesn't get affected, which has always been the strength of Indian markets. And that is where market regulator SEBI is enhancing the whole surveillance mechanisms, and particularly looking at individuals having high exposure so that the enough margins are put in place after the stress test is completed.
This entire process of risk management has been automated, and there are already a lot of checks and balances, and individual investors or traders may not have that kind of power under their belly to influence market or try to curtail the volatility or increase the volatility. What exactly is SEBI trying to do here by doing a stress test of an individual who may not be a big party to the market move?
Siddharth, as you're rightly pointing out, clearly this is more of a preventive measure than a curative measure. Clearly, individual stress test is being done only on, say, big individuals who have exposure beyond a certain threshold, because the first process I was mentioning at the brokerage level is already been completed. So just to give an example, say just before the budget was presented, the margins of brokerages were increased at all levels depending on their exposure. So particularly this would affect maybe only a handful of individual investors, but indeed they would have a huge weightage or exposure or can influence the market. That is where the whole exercise at individual level has been done, and then they can shortlist, say, maybe 100 or more investors where the checks and balances need to be put. So clearly this is more of a preventive exercise to ensure that checks and balances, because we all know how the markets are behaving at this point of time.
Well, one thing is for certain, Vijay, that there are some stocks where the holding in future segment is very concentrated. Like, we were discussing some days back about Fortis, then when India Bull Real Estate was also part of the FNO. And this move probably would be targeting those kind of investors or traders who have concentrated holding in a particular underlying, and their unwinding or deleveraging might impact the underlying very significantly. And this move would certainly be a positive move when it comes to overall risk management. Thank you, Vijay, so much for throwing light on this aspect.